This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
We're in now to Chapter 6, still the law of tort, and particularly the law of tort of negligence as it relates to accountants, auditors, banks, and other people who are asked to provide professional opinions. And we need to start by going back into history, into an early case, Ultramarys Corporation and Touche. It was determined in the case that it's unreasonable to hold a firm of auditors liable to an indeterminate group of people for an indeterminate amount for an indeterminate time. And in this particular case, Touche were held to be not liable. But this was followed by the case Hedley Byrne and Heller and Partners. Heller and Partners are a merchant bank, and Hedley Byrne were advertising agents and were inquiring about the financial stability of a potential new client. So they wrote to Heller and Partners with the permission of this new client, and Heller and Partners responded in very general terms, very normal, generic terms that a bank might give with reference to a specific credit reference. Hedley Byrne relied on the basis that the Heller and Partners bank reference was satisfactory and advanced credit to this new client. The new client went into liquidation, and Hedley Byrne suffered substantial loss, so sued Heller and Partners on the basis of their negligent credit reference opinion. It is important to know that in this opinion given by the bank there was a disclaimer disclaiming all liability for any loss rising as a consequence of reliance on this credit reference. It was accepted by the court that the bank had been negligent, that their opinion was carelessly given, but it was equally accepted that the disclaimer of liability for reliance upon this statement, this credit reference, was effective, and therefore Hedley Byrne were unable successfully to claim money from the merchant bank. We then moved into a case relatively recent, the mid-1970s, a case Jeb Fasteners, J.E.B. Fasteners and Marks Bloom. Marks Bloom, a London firm of auditors, were auditing their client B and D Fasteners. B and D Fasteners were in financial trouble, and it should have been known to the auditors, Marks Bloom, it should have been realized by them that the accounts of B and D would likely be shown to other people because B and D were actively seeking a white knight to come and rescue them. They didn't know of the existence of Jeb Fasteners, they'd never heard of Jeb Fasteners. And Jeb Fasteners made a bid to buy the B&D shares, and the bid was £40,000 to buy the shares, but if there was an unqualified, unmodified audit opinion, then they would raise their bid to £65,000. Marks Bloom did give an unqualified, unmodified opinion, and £65,000 was paid. Unfortunately, B&D was in even worse condition than was originally expected or suspected, and as a result, Jeb Fasteners lost a lot of money and are now suing the auditors of B&D to compensate them for this loss of £65,000. We need to go to the 5-step element here. First of all, we need to establish a duty of care, and secondly, we need to establish that breach of that duty has occurred. That is, a negligent audit opinion has been given. Once we've established that, Jeb Fasteners must show reliance on this negligent opinion. The 4th step is establishing that financial loss has resulted. And crucially, step 5, we have to tie in the financial loss to the reliance. We have to establish causation, that the loss was caused as a result of reliance on the negligently made statement. Was there a duty of care? Well, we know, just general principles, that people owe a duty of care to their legal neighbours. But in the case Candler and Crane Christmas, Lord Denning in the Court of Appeal tried to establish, it was a dissenting view, he tried to establish that a special relationship exists between professional people and those other persons, known or unknown, who the professional organisation should have realised would likely be shown and possibly would rely on the work of these professional organisations. He's saying, is Denning, that Marks Bloom did owe a duty of care to J.E.B. Fasteners. To establish breach of the duty, it's necessary to show that the Marks Bloom audit opinion was given negligently, and it's interesting to note that Marks Bloom never denied their negligence. Step 3, reliance. Can Jebb establish that they relied on the opinion of Marks Bloom? Well, yes, that was easy. They clearly relied, because if the opinion had been unqualified and unmodified, then $65,000 would be payable. If alternatively it had been qualified, then £40,000 was payable. So quite clearly they were able to show reliance on this negligent opinion. Has financial loss been suffered? Well, yes, again, it's easy to establish. £65,000 has been lost. But now we come to the problem of causation. Was the $65,000 loss as a direct result of reliance on the negligently made statement? And the answer is no, it wasn't. They were already committed to spending $40,000. Only $25,000 of the $65,000 loss was attributable to reliance. But the courts are not prepared to say part of it is this and part of it is that. The loss is $65,000 and a loss was going to be suffered. One of the members of the Court of Appeal, a man called Sir Sebag Shaw, said, "The plaintiffs have woven for themselves a metaphysical trap into which they have subsequently fallen. By proving reliance on the Marks Bloom audit opinion, by proving that they have increased their bid price from $40,000 to $65,000, they have at the same time also proved that the loss which was caused was not as a direct result of reliance on the statement and not due to any other factor." Now we come to relatively more recent cases, the case particularly Caparo and Dickman. Dickman brothers were directors of a company called Fidelity. Caparo owned 7% of Fidelity, and Touche were the auditors. As a result of seeing the financial accounts, which showed a profit figure of $1.3 million, Caparo made a bid for the other 93% of the shares and were successful in buying these. However, this $1.3 million profit reflected in the accounts should in fact have reflected a loss of $400,000. So Caparo sued the directors and sued Touche, alleging that a duty of care exists. And the auditors, Touche, said, "No, we don't owe a duty to you with 7% and you with 3% and you with 500 shares. We don't owe a duty of care to individual shareholders. We owe a duty of care to the company, which is represented by the aggregation of shareholders." Caparo said, "You owe a duty of care to the members of the company, and we are a member. We were a member of the company. We were a 7% holder. But no, the duty of care owed by auditors is a duty which is owed to all the members in aggregation. The duty is owed to the company as a whole and not to individual members." It's important to realize that an audit report is not intended to be used for the purposes of making investment decisions. And this is exactly what Caparo were claiming, that as a result of reading that audit report, they made an investment decision. The case ADT and BDO concerned an audit report by BDO, and the partner in charge of the audit, a man called Martin Bishop. ADT were targeting a company called Britannia, and BDO were the auditors of Britannia. Negotiations had taken place, and discussions and meetings had taken place between the ADT directors and the Britannia directors. And one of the very last meetings was a meeting by the BDO partner, Martin Bishop, with the directors of ADT. At that meeting, the directors of ADT turned to Martin and said, "Do you stand by the audit report in front of us?" Now Martin should have said, "Gentlemen, may I refer you to our audit report on page 33 of the financial statements, which clearly sets out the scope of our work, our responsibilities and management's own responsibilities. It clearly shows the basis of our opinion, and it clearly expresses our opinion that in our opinion it says that we do believe the accounts do show a true and fair view." This is what Martin should have said. "Please may I refer you to our audit report." But he didn't. Instead he said, "Yes, we stand by the audit report." ADT invested, and the assets were shown, the company was shown in the financial statements to be worth 105 million, but in fact, when proper accounting policies were applied, the company had a value only of 40 million. As a result, 65 million was lost by ADT, and they sued BDO. BDO defended themselves in the way that accountants do and said, "The purpose of an audit report is not for reliance by person or persons unknown to make investment decisions. The purpose of an audit report is to express an opinion on truth and fairness of the financial statements, and the duty of the reporting auditors is a duty to the company as a whole. It's not a duty to individual shareholders. We have no duty of care to ADT." That's questionable, following the Candler-Crane Christmas Lord Denning expression that there is in fact a special relationship. However, ADT said, "We didn't make our investment decision on the basis of reliance on the audit opinion. We didn't rely on the audit opinion at all. What we did is that we relied upon the oral statement of the authorized representative of BDO. We relied on the oral statement of Martin at this meeting, and we said, 'Do you stand by your audit report? Are these figures true and fair?' And Martin orally said, 'Yes.' So they were able to show, ADT were, that in fact their reliance and their investment decision was based on the basis of a conversation rather than on the basis of an audit report. As a result of this case, it's accepted that the courts expect a greater degree of skill and care from accountants and auditors when they're being asked to give advice of potential takeovers. The reason? Because the potential losses arising or suffered as a result of a poor takeover can be substantial. In the case NRG and EY failed properly to suggest the possibility that some targeted companies by NRG, some of these companies, might suffer huge reinsurance losses. In addition, it was alleged that EY had used defective actuarial methods in their calculations, and they failed properly to assess whether losses could be insured against. The courts held that in fact the advice given by EY was as competent as any professional organization could give. The nature of the problem, the nature of the business, was so complex that it was not fully understood generally. And therefore EY's advice and EY's report was as good as it could be at the time it was given. In addition, the defective actuarial methods had actually no effect. It was established that NRG were going to invest anyway. In the case Barings and Coopers, Coopers and Lybrand were the auditors of the Barings subsidiary in Singapore, which was in the control of the local manager, a now infamous person, a man called Nick Leeson. And Nick Leeson had the authority and was dealing in derivatives, but he was dealing ineffectively and poorly and ill-advisedly, and as a result the Barings subsidiary in Singapore suffered such huge losses that the Barings Bank itself went into liquidation. This bank had been established more than 200 years earlier, and it was destroyed effectively overnight. Barings sued Coopers, who had provided consolidation schedules to the parent company about the overseas subsidiary. Coopers denied liability and said, "We're the auditors of Barings overseas. We're not the auditors of Barings. We have no duty of care to you, Barings, the parent company." But the courts determined that with a special relationship, Coopers and Lybrand should have realized its normal practice. They should have realized that the consolidation schedules would be relied upon by the parent company, if only for the purposes of consolidating the financial statements. And therefore a duty of care did exist between Coopers and Lybrand and the parent company, and Coopers and Lybrand were therefore found liable. In the case BCCI and Ernst Young were the auditors of the parent company, but they were not the auditors of the subsidiary BCCI overseas. Now clearly it must be the case that the auditors of the parent have a duty to the parent. And we've just seen in the case Barings and Coopers that the auditors of a subsidiary have a duty to the parent. But what's being claimed here is that the auditors of the parent have a duty to the subsidiary. Now it's not normal practice that audit information should pass down the line through the group from parent downwards into subsidiary. It's obviously the case that information flows up through a group to the parent company, but it doesn't flow downwards to the subsidiary. Ernst Young were found not liable. There is a recent case of the Royal Bank of Scotland and Bannerman. Bannerman, a partner of a Big Four accountancy firm. And in this particular case, the auditors were alleged to be negligent, and as a result of the negligent audit opinion, the bank relied on this opinion and advanced further credit to the mutual client of the bank and the audit firm. It's an established principle that an audit report is not to be used for the purposes of investment decisions, which effectively is what the bank was doing. But the court in Scotland said it's time auditors stepped away from this shelter. It's time that auditors accepted that they do have a duty of care, a duty of responsibility. It's time that they acknowledged that other people will look at and will rely on the audit report. And the court in Scotland held this Big Four firm to be liable. There's two interesting elements with reference to this case. First of all, it's a case which was determined in Scotland, and Scotland is not England. And Scottish law does not establish precedent in English law. Secondly, as a direct consequence of this decision, it is now common practice, certainly within UK auditing firms, it is common practice to include as paragraph 2 in a normal audit report a disclaimer of liability. It says effectively that the purpose of this audit report is to satisfy the requirements of the Companies Act, which require us to report in terms of truth and fairness our opinion on the view shown by the financial statements. Our duty is owed to the company, represented by the membership of the company, but represented by that membership in aggregate. We don't owe a duty to individual shareholders. We owe a duty to the combined body, the aggregation of the shareholders as a group. And therefore, we accept no liability or responsibility to anybody who uses this audit report for any purpose without our prior consent. It's also surely got to be a good defence to show that, in fact, you were not negligent. And in the case Lloyd Chaham and Little John the auditors were alleged to have reported negligently on the accounts of a trailer rental company which was the target of Lloyd Chaham. Lloyd Chaham took over the trailer rental company and suffered substantial losses. On further investigation into the accounts, they determined 3 separate areas of falseness or misstatement. They determined that salesmen's commissions had been under-accrued. They determined that the replacement policy of the tyres for these trailers was an ineffective and nonsensical approach. In fact, on reflection, the IFRS has now said that it is the proper approach that was being used. But Little John's, bless them, Little John's had recommended that 1/3 of the cost of replacement tyres should be provided each year, so that at the end of every 3 years there will be a sufficient fund or sufficient provision in order to replace all these tyres. And there was a third element, a third mistake, to the value of £367, which the court threw out as being a non-consequence of such little value that it wasn't even worth bringing it into consideration. Little John felt that their audit was up to standard, and their audit file was passed to one of the Big Four firms. The Big Four firm looked at it and said they could see nothing wrong. According to the information on the audit file, Little John were justified in giving their unqualified audit opinion. Little John had collected together sufficient, relevant and reliable information in order for them fairly to express the opinion which they did express. So, contrary to the advice of their insurers, they said, no, we want to go to court. We believe that the quality of our audit is up to standard. We feel that it would be wrong for us to settle a claim for negligence out of court. We stand by the quality of our audit work. And the courts agreed. A good defence, surely, is to show that you were not negligent when you expressed your audit opinion. Finally, on this page, we've got the possibility introduced by the 2000 Limited Liability Partnership Act. The possibility of combining the better characteristics of a company and limited liability with the characteristics of flexibility of a partnership, a sort of halfway mixture between partnerships and limited liability companies. The effect of it is that partners are able to ring fence, to build a protective fence around their personal assets, so that in the event of a disaster, in the event that the partners of an audit firm are found to be liable, there is a limitation on the extent as to how much money they should have to contribute. Limited liability partnerships were first introduced by the 2000 Act, and one of the first firms to take advantage of this new management structure was the firm of Ernst Young. It seems to me that any firm of auditors or accountants would sensibly establish something along the lines of a limited liability partnership. And finally, incorporate. This is simply converting an accounting partnership into a limited company. KPMG has created themselves into KPMG Audit PLC. It's a public company. Itself requires an audit. Itself requires publication of its accounts. but it is a public company, and the partners of the former partnership are now shareholders of this public limited liability company. And it means that, following general principles and ordinary principles of company law, the liability of the members of the company is limited to the amounts, if any, as yet unpaid on shares held by them. I can't believe that a firm of auditors in the UK would sensibly avoid either creating themselves as a limited liability partnership or alternatively incorporating their business as a company. And that, ladies and gentlemen, is the end of this little lecture on tort as it applies to accountancy and other professions.